Evening, everyone. My name is Denise Smalls. Welcome to Creating Wealth by Investing. Thank you for sharing your part of your evening with us. I have my co-worker, Latricia Holt, on here as well. And then, of course, our esteemed guest, Mr. Ken Howard. Before Mr. Ken Howard takes over, I am going to tell you a little bit about us. The host of this webinar is the Westlakes Financial Wellbeing Center, and we provide free services to the Westlakes and 32805 community. So we provide virtual financial counseling, financial webinars. We help provide resources for job placement, career resources, and community resources. In addition to that, we have been doing webinars since the pandemic last year. And so we created a YouTube channel. So you could use this link here and you could just copy and paste it into any browser and you will be able to see any of the past webinars that we have created in the last year. In addition, like I said, we do financial counseling that's free. All of our services are free. So please contact Latricia Holt at the telephone number or the email. And just wanted to let you know that the Financial Wellbeing Center is sponsored by Lyft Orlando and Truist. Just to provide some information to you, everyone is currently muted and your videos turned off. So please, as we go along, if you have any questions for our speaker, please feel free to use the Q&A feature and the questions will be answered. Once the guest speaker is finished, I will place a post-test link in the chat. So again, it's just going to be a link. All you have to do is click on that link. That will be our post-test assessment. And please put your full name, answer the questions, and just hit submit. We will have a raffle drawing when all the post-test assessments are received. So this post-test is the same questions that you guys already answered. So you already have all of, you will know all the answers because Mr. Howard will provide all of that information, but it's the same questions that you answered when you registered. And then just to let you know that we collect and maintain your registration information to communicate with you about our future webinars. So thank you again for your participation. And I'm going to stop sharing my screen. So before I pass the baton over to Mr. Howard, just want to tell you a little bit about him. Mr. Howard is the founder of KLH Financial Services. KLH, formed in 2003, provides comprehensive financial solutions utilizing 8 wealth management principles. In this capacity, he coordinates financial products and services to retail, commercial, and government clients through multiple delivery channels. Prior to becoming a principal at KLH, Ken has 18 years of experience in the banking and financial industry. Ken started his career in the financial field after obtaining a Bachelor of Science in Finance. His focus on finance has been longstanding. KLH Financial Services' goal is to promote financial education and build financial wealth and security for those he serves using time-tested principles and strategies. Mr. Howard is licensed by the State Department of Insurance and the Financial Industry Regulatory Authority, or FINRA. He also has his Series 7 license, his Series 63 license. He has the State Insurance Life, Health, and Variable Annuity. He's an enrolled agent, and he also holds certifications in financial planning from UCF and commercial leasing from the University of South Florida. So as you can see, Mr. Howard has a lot of background in finance. So please, please, please ask all the questions. Don't send us emails after. Ask all your questions to Mr. Howard because he's definitely knowledgeable in this area. So thank you, Mr. Howard, and the floor is yours.
Thank you, thank you, thank you, thank you for that kind introduction. Can everyone hear me? Okay. All right. Okay. I want to thank everyone who's attending for taking time out of their busy schedule to learn about smart, excuse me, smart investing principles. So we're gonna jump right into it. And I do have my able assistant here to help me navigate through this, this Zoom project. And so can everyone see my screen yet? Okay, let me share my screen just to make sure. Okay, all right, so we're going, is there any way we can enlarge that a little bit? Okay, as we get to that, we're going to talk about 5 smart investing principles. But before we get to the principles, we need to make sure, and I believe I have heard in earlier sessions, you all have discussed budgeting, debt management, and other matters that are critical to having that foundation before you get into investing. So I'm going to assume at this point that that information has been given to you and you are at the point where you're able to consider a medium to long-term investments. So we're going to talk about 5 smart investing principles. Now, there's lots of ways to get information today, obviously through the internet and through magazines and various publications. But all of that information is good, but it needs to be channeled in a way that is beneficial to you. Next, please. You heard the introduction of KLH, and what we're doing with this Zoom seminar today is building a strong foundation. Now, again, as I said a few minutes ago, the foundation hopefully has already been built through earlier seminars where you learned proper debt management, you learned how to have a strong credit report, and you also learn how to make sure that you have an emergency fund so that when we get to the investing stage, you do not have to divert your investing monies for emergency. So again, tonight we're going to focus on investments. Next, please. Okay, you've already heard about my background, and thank you very much, Denise, for that kind introduction. Next, please. Okay, again, you in earlier seminars, hopefully you have talked about your savings emergency fund, the budget, the importance of a good credit score, and how to manage debt. And so again, we're going to get into specifically the investment portion of our seminar. And in investments, just a quick definition is any outlay of funds for which you expect not only the return of those funds, but earnings or additional funds from that initial outlay. Okay. And we're going to talk about establishing goals or objectives, understanding risk tolerance, and last, we'll touch on the various types of investments. And again, if you guys have any questions, please put them in the Q&A, or also you can utilize the chat if you'd like. Okay, so goals or objectives. You need to really understand why you are investing. What are you investing for? And it's very important to be realistic in your investments. And by that, I mean, don't go for pie in the sky type of returns if you're just getting into the game of investing. And as we know today, there are many ways to invest, and we'll talk about some of that later, but you have to be realistic with your goals and objectives. Think about things that you can successfully accomplish so that you are encouraged to take the second step or the second part of your goal. And really, you need to understand that time is on your side. It's not really how much money you have. Money is important, and you need money in your investments, but you need more time to invest than you need money. And another key is consistency. It's a significant key to success, really, in anything you do. So with investing, it's no different. You need to be consistent in whatever endeavor you're choosing to invest in, be it real estate, be it stocks, be it bonds, be it a business that you want to start. You have to be consistent. And many of you on this call have heard the acronym SMART when it comes to establishing your goals. And we know that, the S stands for specific. We know that the M stands for measurable. The A stands for achievable. The R is realistic, and the T is time-tested or timely. So when you endeavor upon a goal, be it to get a job, be it to invest, be it to go to school, whatever the situation is, you should utilize that acronym and make sure that you are realistic or smart in your endeavors. So definitely with investing, definitely be smart about it from the beginning. Next slide, please. Okay, now we're getting into the meat of the 5 SMART investing principles. And they are, number 1, estimate your time horizon. Number 2, know your risk profile. Number 3, diversify, diversify, diversify. Number 4, consider or don't forget taxes and inflation, and that's extremely important. And number 5, get started now. Don't procrastinate. And further down, we'll look at the specific costs of procrastination, given an example. Next, please. Okay, number one, estimate your time horizon. In the investment business, there are short-term, midterm, and long-term goals. Again, even though we're talking investment, which typically is, for most people, is considered mid to long term, there are some short-term investments. And those investments are typically 0 to 3 years. And even for that short period of time, there are investments that can give you a return, from 2 to maybe even 10%. However, those are pretty much reserved for the higher risk takers for that short period of time, obviously for a bigger return. If you're interested in what I would call a fixed or a sort of flat return, there are investments for that as well. And so the short term is considered anywhere about 0 to 3. Midterm is 3 to 7 or 8 years. And then anything beyond that is considered long term. But however, that depends more specifically on your time frame than just raw numbers. So it really kind of depends on what your expectations are for that particular investment. For example, if you're investing in a short-term bond because you have, let's say you have just a couple of $1,000, but that you don't need right away, but you don't want to take big risks in the stock market, you could get a short-term bond that will give you a guaranteed rate of return, and that is an investment. Okay, so it doesn't always have to be stocks. It could be different types of investments that we'll talk about later. So know your time horizon. Okay, not your buddies, not your whoever you're talking to, but it's your time horizon. Okay, next, please. Okay, understanding risk tolerance. This is very, very important because we want to be able to sleep at night. We want to be able to invest in something that will not cause us significant heartburn and the inability to to handle our day-to-day task. Okay, and so once you understand your time horizon, that kind of builds into your risk tolerance as well. And there are, conservative, moderate, and aggressive. And so that kind of matches almost with the time horizon in many ways, but you need to understand what you're getting into in terms of the risk tolerance. For example, real estate could be considered an investment, and for some that might be considered a conservative investment, depending upon their cost to get in or their cash flow from that investment, while others may consider it very aggressive. And there are various ways to get into the real estate market. And so buying a house and a fixer-upper is just one way, but another way might be to invest in what is called a real estate investment trust. So you really have to understand the investment and the fluidity or the volatility of that investment, because that makes a difference in your risk tolerance. Okay. And here is a key question that is, once answered, gives us as financial professionals an understanding of your risk tolerance. And it says right there in the green, it says 6 months after you make a $100,000 investment, and that could be 10,000, it could be 1,000. So, you know, don't let the dollars throw you off, but it basically says if that investment decreases by 10% in a down market, how would you feel? What would you do? Would you panic? Would you sell? Would you throw up your hands and say, I'm done with investing? Or would you say, you know, the market is down, now is a good time to buy more? And so answering that question honestly for yourself based on your time horizon and how conservative, moderately, or aggressive you want to be with that investment helps in answering that question. So that's a very important question to answer. Next, please. Okay, ask yourself, what happens to my outlook if the value of my investment drop? That's what we just asked. How much could I lose and stay in the market? Okay, some may get out at 10%. If the market drops to 20%, are you still willing to stay in long enough to recoup your 20% and grow some more? Or did you get out at 10? So you have to really understand before you go in how much you're willing to lose as well as gain, because oftentimes we go into the market and we just stay without really paying attention to what's going on. And that's not good as well. So you also need to understand what you understand or don't understand about the market. So you need to have a good investment knowledge before you make that leap into the market long term. Always remember that only the money that you're willing to lose should go into the market from the investment standpoint. Because remember now, we already have our emergency fund, so we're not going to jump off the cliff, okay, or not invest if we need a couple of tires or something comes up where we need an emergency fund. Next, please. Okay, here is a pop quiz on Know Your Risk Profile. Which would you rather have, 500 right now or a 50% chance at 2000? And this question could be answered based on your risk profile. That I wouldn't say that there is an exact answer, but some may choose 500 right now or a 50% chance at 1,000, while others may choose 50,000 right now or 50% chance at 200,000. That's an interesting question. Next, please. Okay, now we're going to talk about quickly the various types of investments. There are what are considered cash and cash alternatives that are considered low risk, but the potential return is also fairly low, is very low, because if you think about it, the interest rates today are pretty low. And so, you know, what are we getting? Maybe half of 1% on a money market account, which is considered a cash alternative. And so low risk, low return. But then we can move up the scale a little bit with debt or bonds, which again, in this low interest rate environment, is not returning very much. It's more than cash or cash alternatives, but the good side of the debt alternative is pretty much, you know, you have fixed returns, although low, they are fixed. And then of course you can move up the risk profile by purchasing stocks, and stocks represent ownership in companies, as opposed to debt that does not represent ownership. It represents a loan to a company, and they agree to pay you back a fixed rate of return. And so, and with stocks, there are various types of stocks, from conservative, or what we call blue chip, the big companies that have been around for a long time, that tend to pay dividends consistently, to startup companies, to penny stocks, to various types of stocks. So it's very important, if you're going to get into the stock market, you understand as much as you can about the company, its earnings, whether it pays dividends or not, the management of the company. You really have to study the company and how it operates in order to get a good feel for stocks. Now, you also can follow various financial analysts that tend to have more information, maybe some non-public information about the various companies. So stocks are typically good investments, but only for those that are willing to do a little homework in understanding what they're buying, and typically are not in for the short term. Stocks are something that you don't want to generally buy today and sell tomorrow. Now, I say that with the understanding that there are day traders that do that. But to this audience, I would not recommend you get into day trading unless you have some experience already with stocks. And then, of course, there are speculative investments like art and paintings and other NFTs, what they call it, non-fungible, or things that you can speculate on. Gold, as an example, would be a speculative investment. Okay, do we have any questions? Okay. I don't know if, do you want to answer the question now, Denise?
Whatever's your preference. I see the webinar, I'm sorry, the question is more about will there be any sessions on learning the market? And at this point now, we do not have any sessions currently about learning the market and anything planned. But if you contact us, Ms. Keaton, we can definitely look into finding you some videos or webinars or what have you about that. If you have any other questions, please let us know. Thank you, Ken.
Okay. Thank you for that opportunity, that question, and an opportunity to take a quick break. All right, moving right along. Any questions thus far on what has been discussed here? Again, please put them in the Q&A. Okay, as we talk about your risk profile, there are external risks and there are company-specific risks. And let me give you an example. And Ms. Keaton, this is kind of part of learning about the market. The external risks are those risks that the company cannot control. One example might be inflation. Another example might be currency exchange if they're doing business in a different country. And there are others, but that's the kind of thing you learn about as you learn more about the market. On the other hand, there are company-specific risks. For example, it might be a labor shortage for that particular industry, or it might be something, again, that's specific to that company, the way they do business. The CEO has a scandal, for example, and that is specific to that company. It might be a competitor CEO that doesn't have a scandal. And so, you know, the company without the scandal might tend to do better than the company with the scandal. So that's why, again, it's very important to get as much public information about the company you're going to invest in if you're buying stocks as possible. And the same thing holds for bonds or any other investment that you choose to purchase. So understand the basic between external and company-specific risks. And that'll help you understand your profile as well, or your risk profile. Next, please. Okay, so here we're talking about the different types of investments, financial versus non-financial, and they are listed here, and we've discussed some of them: stocks, bonds, mutual funds. We haven't talked about, but mutual funds are simply a basket, if you will, of stocks. So it's different company stocks put together and sold as a mutual fund. Various companies, instead of buying individual stocks, you get the stocks, put them together in an envelope, if you will, and sell them as a mutual fund. Commodities, grain, corn, lumber, etc., are your commodities. And REITs, real estate investment trusts. That's what the REITs stand for. And that's where you package real estate, or you get various real estate properties, package them together, much like you do mutual funds, and sell the REIT. And of course, cryptocurrency, such as Bitcoin, etc. And then we have the non-financial, real estate, businesses, and again, commodities can be non-financial or financial. Okay, if you have any questions about the types of investments, please put it in the Q&A. Next, please. Now, I believe this is number 3, if I'm not mistaken, of the 5. Diversify, diversify, diversify. And here is an illustration of diversifying. If you have $750,000 or 50,000 or 25,000, whatever the case may be, again, don't let the numbers throw off the concept, but do I take all of my eggs and put them in one basket or a single investment, or do I diversify, 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 as we're discussing here, in order to spread the risk? And the reason it's important to diversify is that there's a possibility when one investment goes up, the other may go down, and you can offset, or and it's in the business, it's called correlation. And you don't want too much positive correlation. You want things that tend to move in opposite direction. Example, if you put your single investment in an investment and it goes down, you've lost that investment. But if you split it, and you can split it 2 ways, you could split it 3 ways, you could split it 4 ways. As long as you are getting diversification in your investments, then you stand a better chance, no guarantee, but you stand a better chance of gaining profitability as a result of the diversification. And as it says below here, diversification is an approach to help manage investment risk. It doesn't eliminate the risk of loss. So that's what you need to remember. It doesn't eliminate, but it helps manage the risk by diversifying. Next slide, please. Okay, here is an illustration of a diversified portfolio after 20 years. With a single investment and a 5% return, the investment total is $1,989,973. However, if we diversify and one return, we diversify into 2 here. We have an 8% return and we have a 6.5% return. The value, as you can see, is $2,046,150. So actually we have 3 investments. One broke even or didn't earn and didn't lose. Okay. So again, diversification is an approach to manage risk. Think of it that way, not to eliminate, but to manage risk. Okay.
Can you have a question in the chat?
All right. In the chat?
Yes, sir.
Okay. And the question is, do you have what is a good investment to start for my children? Is that the question? from
Yes,
Ms.
sir.
Forbes? Okay. Well, without knowing all the particulars, for children, I'm a big proponent of education. So my thought is, and again, I don't know the entire picture, and I admit that, but my thought is a 529, a college savings plan. Now, it's important to really know, to understand that that is an excellent vehicle for saving, not just for college, even though it was originally designed for college. It is a plan or a program that you can use for anything, but as long as it is used for college or for education, I should say, not even it can be used for trade school, but it is, as long as it's used for education, there is no tax on the earnings, okay? So that would be a easy recommendation if you haven't started that for your children.
And Ken, in the Q&A, you have a comment and a question.
Okay, let's see. Okay, Michelle says she's interested in real estate investments. Okay, and what is my opinion on investing in the prison system, like Bob Barker, etc.? Miss Henderson, I really don't have an opinion on that because I am not aware of the specifics regarding Bob Barker and his investments or the system. So I'm going to defer that for now. So I have not studied that or that area. So I'm going to pass on that one. I do like real estate investments for certain clients. And it just kind of depends on the type of investment. Okay, do we have anything else before we move on?
Oh, another question just came in.
Okay. Okay, the companies that supply canteen food and other supplies. That would be something that you would have to know more about. Again, I am not familiar with who supplies the food and other supplies to the prison system, but I can say that it sounds lucrative, but more information definitely is needed. So might be something to look into. There's a comment, there's so much to digest in a single session. An investment for seniors would have to be for other short-term return. Okay, Mr. McLean is saying short-term investments would be his direction. Ms. Henderson is looking to invest in a multifamily home. Okay. Yeah, just comments. So we'll continue, and I'll entertain other questions or concerns as we progress toward the end. Okay, any questions on the diversification? Next, please. Okay, here is where I was talking about the correlation. And this is an example of what in the business we call beta, understanding market moves. And a negative beta equals a negative correlation. And so you want things to actually move in the opposite direction, or you want positive correlation. So positive correlation means that everything is not moving together. And so this is a hypothetical example used for illustrative purposes only. And so beta is something that's calculated and is given to you as you read the prospectuses of the various marketing material for which you're considering an investment, especially if it's stocks. So you should always read the perspective, which explains the investment objective of that particular investment. And beta is just one of the calculations that will kind of tell you how the stock is intended to move, whether it's less volatile than the market or more volatile. And again, this is information that you factor in as you determine your risk profile. Okay, next, please. Now, here is something that we cannot get away from, we can't avoid. And even with minor investments or huge investments, or you have to consider taxes and inflation. And taxes, you really need to understand if your investment is pre-tax or after tax, or is it taxed on the way in? Is it taxed on the way out? And then inflation. And right now, as many of you may know, we have pretty mild inflation, and it has been for several years. But there is talk of perhaps inflation kicking or rearing its ugly head, if you will. And inflation can be described very simply as too many dollars trying to purchase, fewer items, or it's basically where the price of things go up. Okay, and so this illustration, and it's old, it's from 2018, but it shows the days work to pay your taxes. And so in this example from 2018, it took 44 days to pay the individual tax bill of the average person. And so this is just information only. But the key is understanding or considering, if you make an investment, understand the tax implication and factor in an inflation. For example, if your investment is, let's say your net return is 7%, and then taxes will take away from that, and so will inflation. So you really need maybe a 10% return to net 7 or 6, whatever the case is. So you need to kind of determine what you're trying to net and then account for taxes and inflation as well. Next, please. And here's an example. And again, I do apologize. These numbers are a little dated, but the concept still stands. A new house in 67 may have cost $14,250. That house today would be $402,900, all because of inflation in this particular case. Income, you see that the gallons of gas, much higher than $242 today. And then the price of a new car significantly increased over the 40-year period there between 67 and 17. And this source of information is from the Kelley Blue Book. Next, please. Now, here is the $350,000 decision. And this is what happens when we procrastinate. Okay. And in this particular example, if you invested, let's say, $250,000 in an account earning 6%, at the end of 20 years, your account would be $801,784. Again, we're depositing $250,000, and we're going to stay in that investment for 20 years. And so if we earn 6%, it will be $801,784. However, if we waited 5 years to make that same $250,000 investment, we would only have 15 years of earning. And so thus we would earn $599,140. So our $250 only grew to $599,140. Now, if we waited 10 years to start, we didn't start until 10 years later, and we still, we kept it for 10 years, then you can see it would only grow to $447,712. So the key, and I said this at the beginning, is you need more time than you do money. And so you can see the difference here that time has made with the same amount of money. So the key is to get started. Whatever the amount may be, the sooner you get started, the better. And obviously the longer. Now, don't get started and stop a year later, because you're not gonna get very far. The key is to start and to stay the course through whatever period you're aiming for or needing the money for. And yes, you need more time than money. Next, please. Okay, so here are some things that a checklist to help make a determination if you're ready to invest. We're talking about investments. So you should have a personal income statement. You should have a personal balance sheet. And the balance sheet is simply what you own and who you owe. And the difference between the two is your equity. And so you should know, who you owe and what you own. And then you should determine, and you can have short-term goals, medium goals, and long-term goals. It's not like you have to pick one or the other. You actually can have all three, but you need to define all three and purchase the appropriate investment for all three. And of course, you absolutely need to understand your risk tolerance, because this risk tolerance, if you have a good understanding of that, it will be beneficial in you staying the course, because you'll understand that things go down, but they also go up, and they go up, but they come down. So you'll understand that because you're tied in to the long, medium, or short-term goal. Okay, look like I have a question. And it says, what avenues can we take to start investing as soon as possible? Well, what avenues can you take? You can take the avenue of self-investing through mutual funds. If you haven't started, I wouldn't necessarily, for example, what places or websites? Personally, I would recommend Investopedia.com because it's an educational website. There are websites like Robinhood where you can immediately start investing, but my recommendation is to start through education first. Investopedia.com is an excellent website for educational purposes. Okay, and we'll put that in the chat. Okay. Next slide, please. Okay, so we've talked about the 5 smart investing principles. And again, they are time. Let me see. Understanding your risk profile. This is it. I can't see. Yeah. Diversify. Taxes and inflation. And getting started now. Don't procrastinate. Just get started. But get started with education first. There are lots of people that just jump in, and you can just jump in, but I would recommend that you get started with education through I mentioned Investopedia. Read journals, go to the library, ask questions. There are lots of ways to get additional information. And I have a question. How do I feel about apps like Spare Change? Not familiar with that one, but Motley Fool might be a website that you can learn more about individual stocks. There are really just so many to name. I can't think of all of them right now. Okay. Are there any other questions right now that I can answer for you? Okay. Do you have to have a broker to start investing? No, you do not have to have a broker. As you know, Robinhood and other do-it-yourself brokerage companies don't require a broker, and so you can purchase them yourself. But the key is to know what you're purchasing and why you're purchasing it. So that's the key. Is there a minimum to start investing? Many companies do have minimums, particularly if you're not going to consistently invest. Most of the companies require at least a $50 minimum investment, but that minimum is assuming that you're going to do what we call dollar cost averaging, or a monthly systematic investment plan. None of the brokerage companies want you to put in $50 and stop. That does them no good, and it does you no good. The reason is there's a lot of paperwork from the regulatory standpoint involved in opening an account. And it costs the brokerage firm money to open that account. And even though many brokerage companies have automated that process, it still costs money to maintain an account. So it would behoove you to consistently make that monthly investment as long as you can, because the money will grow faster and you'll establish the relationship with the brokerage company. Okay. So to answer that question, the minimum to start is about $50 for some. For others, for your main street brokerage type firms, it varies anywhere from $1,000 to some firms require a minimum of $20,000. So you just have to find the brokerage firm that fits what you can afford. Okay, let's see, any other? How much would you need to invest in large companies? What about penny stocks? Two different questions. Large companies, you can invest with $50 if you find the brokerage company that will allow that. And penny stocks are volatile, but can be lucrative. Again, it just depends on the particular stock, but they are considered, penny stocks are considered volatile. Tell us more about real estate investing. Real estate investing, if you're not doing it through a REIT, can be, what's the word I want? You need quite a bit of money, and it depends on what you're investing in. But again, I would just do my research. That question is sort of broad. Tell us more about real estate investing. You can invest through a REIT cheaper or less expensively than getting a fixer-upper and fixing, rehabbing a fixer-upper. So REITs are typically the way the smaller investor get into the market, but there are restrictions even on REITs. So some of the real estate investment trusts are reserved for what we call accredited investors. So there's a lot to learn there about real estate investing. Can you spell that, please? Spell what, Ms. Henderson? What am I spelling?
REIT.
REIT is REIT. That stands for Real Estate Investment Trust. REIT. Yes, REIT. R is for real, E is for estate, I is for investment, T is for trust. Okay, about rental properties. You can purchase a rental property. The key there is to purchase it, go in at the right price, because if you purchase a rental property at the wrong price, you're not, or cost, I should say, you're not going to be able to cover your mortgage, your taxes, your insurance. You have to make sure you can cover that, as well as maintenance on the home. So you purchase a property. If you don't purchase it right, the rental income will be insufficient to cover your mortgage, taxes, insurance, and maintenance. So you'll be what we call upside down, and you'll be putting in more money than you're receiving. And so that then negates your quote, quote, investment, because you're then the lender and not the recipient of income. And you invest in things like Walmart and Amazon through either mutual funds, would be my recommendation. Find a mutual fund that you can invest maybe $25, $30, $50 or more dollars a month in a mutual fund that has Walmart and Amazon as part of its portfolio. That would be the way I would invest in Walmart and Amazon, rather than buying the stock individually. I would spread the risk by buying a mutual fund that has Walmart, Amazon, and similar type companies as part of it, as part of the mutual fund, that is. Okay. I think we're about out of time. Any other questions, or Denise, you want to take it from here?